In this video, I'm going to go through the crypto market. I'm going to show you where the structural levels are. Structural levels are incredibly important. I'm going to explain what retail does and how to avoid it. I'm going to show you real trades over the past couple of days. Then I'm going to go into the main markets and have a look at the tier 1 charts and make an assessment where the market could be going from here. Let's run the numbers. To understand the health of the crypto market, it's really important to look at total crypto market cap. This is the market capitalization of the entire cryptocurrency market, Bitcoin, Ethereum, and all the other alts. This is literally the combined market capitalization of everything inside crypto, all the coins, all the tokens, everything. It literally gives us the heartbeat of the crypto market. It's a very important chart. But how do we know if this chart is strengthening or weakening? The answer to that, we use technical analysis, support and resistance lines. For example, if we draw a resistance line up here, we can see total crypto market cap is trying to get up, but it's being pushed down by sellers. We can tell an entire story by this line. We can also tell a story by this line drawn from here to here. This shows that the market is under several levels of resistance. I'll explain shortly why it's really important not to do story-based analysis. What about if we drew this resistance line? This shows us that the market is improving. What about this secondary resistance line? Here we can see the market is improving based on current price. And when people draw support and resistance lines, you'll find that they try to explain price around here. This is a huge mistake. What if we draw another resistance line through here? We can see that total crypto market cap is under pressure at the current time. You can quickly see that we've drawn a number of resistance lines and they're starting to throw conflicting signals. But this is not the reason that these lines are misleading. It's for some other reason. I'll explain. These lines have been drawn over 2 days and 9 hours. To explain how dangerous these lines are, I'm just going to employ a little bit of math, but it's really simple. If we take 2 divided by 3892, because total crypto market cap has been trading for more than 3,892 days, we divide one into the other. We get a number, multiply it by 100, get it to a percentage. You can see that this is 0.05 of 1%. It's not 5%, it's 0.05 of 1%. That is 1/20th of 1%. That's really small. This actually means that we're missing out on 99.95% of the action. If you were to purely make your decisions based on resistance lines like this, you're missing literally all of the price action. But this is what you see commonly referred to on charts. This is called recent indicative price, which RIPs your money. If you're liking the content so far, please smash that like button and subscribe. We'd love to have you as part of our global family. And please note, these are the only things that I'm involved with. You can always directly message me on Twitter at any time. Please be aware of scammers. There are a lot out there. The whole of finance is built on probability and statistics. We could throw in a range of support levels and those levels would look like this. Now you're probably totally confused. What is support? What is resistance? And this is a very small snapshot of price. Literally one that misses just about 100% of price action. How do we get around this? There's a very scientific and standards-based methodology that creates statistically significant information on the lines. I'll just show you it in action. We'll just pop on the monthly service indicator. These particular lines are what smart money looks for. They don't look at recent indicative price. They look at total market structure, which is different from market structure. Institutional traders and investors are a very different breed. They're statistically and mathematically literate. They don't make their decisions based on fear. They make it based on crunching numbers. And what do we see here? First of all, this is absolutely simplified. We know exactly where structural support is and structural resistance is. This is very important, and there's a very simple rule to this. If it hits total market structure and can't get above, it's going to the level below. What are these lines called? They're support and resistance lines based where they are relative to price. They're called Stanfield levels or SLs. When an SL is hit, that's not a stop loss, it's a Stanfield level. When an SL is hit, it is likely to bounce, especially when there are a confluence of SLs. We will see this time and time again. You could look at recent indicative price and try to make heads or tails of what the market is doing, but that is incredibly dangerous because you tend to miss just about everything to do with price. The process that draws these SLs up is called the CTKS method. It's based on level 1 and level 2 standard certification, and you can learn it yourself. But the key is to understand there's a wild difference between retail recent indicative price levels and structural levels. Recent indicative price gives rise to story-based analysis or SBA. RIP, when it creates SBA, creates a nightmare with your finances. For example, if you were seeing just this particular line, you would say, price is very supported. But if you were looking at this line, you would say price is under resistance. For example, let's throw off what the institutions know. They know where total market structure actually exists through objective dynamic market structure, which was invented and incorporated into standards by the CTKS method. The powerful thing here, if you look at price action like this, you can draw lines just about anywhere, but they will not reveal the structure of the market. These SLs do. They are so incredibly powerful. For example, if we look at Ethereum, we have a downward progression on recent indicative price. Just here, we could say if we were retail, that price is under pressure because it hasn't overcome this resistance level. And that's not completely incorrect. I mean, that is correct to a degree. But the problem is, this is just literally a couple of days versus 3,000 days. That means we're missing out 99% of the price information. Institutions, when they trade billions of dollars, are not prepared to do that because they would get sued by their investors. This is why institutions have large research departments. It's not by mistake. But where is the structural support and structural resistance levels, or so-called CTKS structure? We can see it's right here. What you can see is that this particular level, just above price at 2065, that is the actual correct institutional resistance level. And where is the institutional support? It's at 2039. What happens when price hits institutional support? It bounces. When it hits institutional resistance, it bounces down. Bounces up, bounces down, bounces up, bounces down, bounces up. You get the idea. Could these normal resistance and support lines drawn from recent indicative price tell you what price is going to do? Of course they can't, because they missed 99% of price action. From a short-term sentiment perspective, they can be good to look into the mind of retail traders and investors, but institutions just look at it and see where the herd is heading, which is usually in the wrong direction. If you're going through a life pullback at the moment, please know that our global family's love and healing thoughts are with you. You're getting strength for the next life rally. You've got this. You'll be fine. And I would also like to thank you for watching and everybody for commenting. It's just beautiful. A core foundation of financial analysis is probability theory and statistics. For the institutions to take note of something, it must be statistically significant. Now, what does that mean? If we're looking at, for example, at XRP's price, you can see XRP had a major sell-off and then rebounded. The institutions know why this happened. Retail basically has no idea. Let's pop on the indicator. What do we see? progressive levels of smart money buy support down at these levels. These levels act as a confluence of safety nets. If price passes down, we know it's a really simple rule. If it's going down and it can't get above, it's going to the next SL. If it can't get above this one, it's going to the next one. If it can't get above until it starts to hit structural support, the more safety nets we have underneath us, the better it is. Those safety nets act like elastic bands. They pin price backwards. But you can imagine if you were in a bit of a position that you didn't know what these actual levels were, it would be very, very scary to trade or invest in XRP. It would be scary to invest in anything such as gold or oil or the S&P 500 or the NASDAQ or Bitcoin or anything. Simply because you do not know where the safety nets are and where the ceilings are. That is, where the support is and where the resistance levels are. And as you can see, there are multiple levels, not just one. Anytime you see somebody say, the support level is just here, that's not correct. That's not institutional, that is retail. There are multiple levels of support. They act as safety nets, and the stronger they are and the more confluence they are, the better. You can see stronger ones have a thicker line. The less strong ones have a lighter line. The process of analyzing actual price action is really quite straightforward. If it's not going above, it's going below. Interpreting CTKS method levels is really quite straightforward. When you get a lot of safety nets, you expect price to reverse, and when you have a lot of overhead resistance, you expect price to reverse as well, to come down. If price is sufficiently powerful enough, it will consolidate. What we can see right now is inside XRP's price is consolidating. Because you know where the institutional levels are, you can buy and sell with a great degree of certainty. And you can see these trades are just literally over the past couple of days. If we look at ADA from a recent indicative price perspective, we can see it's under short-term resistance. It looks to be weakening. But with a knowledge of the structural levels, we can start to understand exactly where the resistance is and exactly where the support is. Without this particular focus, we just can't figure out where we could put our buys and our sells. And the beautiful thing, you can learn the CTKS method for yourself. Just to give you an understanding on ADA's price chart over the past couple of days, this is some of the trades that I've been doing. As you can see, there's quite a few of them, and you can't say that ADA has been a particularly forgiving crypto at the moment. It's been all over the place. But with the CTKS method, you can print money. Looking at recent indicative price through Doge, we can see Doge is currently under resistance, and it's under resistance in quite a few different ways. But when we look at structural support and resistance lines, it's coming into very nice levels of structural support. And if we think about Doge, it's been up and down, and mainly down. What has the profitability been on Doge? You can see these are sales from trade history. Doge has been quite profitable. But again, you must know where the smart money is buying and selling in order to actually take advantage of these price movements. Solana is a favorite across the crypto market, and it's been doing really well recently. We can see Solana overcame a level of resistance but then hit another one. It's currently coming up to approach to try and get over that resistance. There's a problem with recent indicative price. It never tells us where fresh air gaps are. What is a fresh air gap? That is a methodology that's employed by the CTKS method. It reveals where no structural resistance or no structural support exists. In those areas, price can move very quickly upwards or very quickly downwards. They're vital to understand and to know about. Looking towards the institutional levels, we can see that Solana is currently pretty much smack bang on one. There's one slightly below it as well at 54.63. Solana is currently 58.38. What would we seek here? We would seek support at this level and a rebounding. Something else is happening inside Solana's price structure. But first of all, I just want to give you an understanding. You can make money no matter what the market conditions are. And these are just some of the trades on Solana just recently. You can see that the CTKS method, and this is exactly how I do my trades. I just simply look at the structural levels and I target a specified percent return. That return is everything to do with how the Tier 1, Tier 2 and Tier 3 charts are moving. Inside Solana's price structure, it looked very much like Solana was going to weaken. I took advantage of that by putting my orders down at structural levels, which then got filled. Typical trading and investing systems require a trend. They require a degree of momentum, either in a positive direction or a negative direction. The problem here is that crypto is so chaotic, it can go all over the place very, very quickly. The CTKS method doesn't care where price goes. It can do trending markets and non-trending markets. The proof, of course, is in the trade history, which I showed you. I want to give you a really practical example of how you can apply the CTKS method. And that method is all about total market structure, just analyzing all of price data. What we can see here is Litecoin was overcoming a level of resistance, a couple, and it was supported by price. Then what happened? As price went along, it hit a level and then came back. Now, how could the CTKS method help in a situation like this? And this is a very important thing to actually cover off. When we pop the method on, what do we see? The reason why price reversed, it came into structural resistance levels, and quite a few of them. When structural resistance levels are congregated, that means that that particular group is going to push the price down. Where's it going to push price down to? The next structural level. If it's not going below, it's going above, and you frequently see retests. This actually contains price action. These lines are incredible. They're incredibly powerful. Over the past couple of days, here's just a sample of trades from trade history that I made on Litecoin. You can see that you can do very, very well, but you must know where the structural support and structural resistance levels are. If you just rely on recent indicative price and thereby miss out on 99% of the probabilities, you've got 1% going in your favor. And when you look at the SLs, you can use them to predict where price is going, if it's strengthening, if it's weakening, when it hits support or where it hits resistance. That is incredibly valuable. When we look at normal price action, it's very difficult to understand why price does certain things. Here we're looking at recent indicative price, and we can see that Bitcoin Cash is under resistance. Does this mean we cannot make money going long at spot with Bitcoin Cash? And that is the only way I trade. I don't use derivatives, I don't use leverage, I use spot. The answer is you can always make money, and here are just some of the trades over the past couple of days. It just gives you a bit of an indication that it doesn't really matter what price is doing. It matters if you know structural support or structural resistance levels. I knew, and this is the indicator I use for my own trading. I saw that there was a lot of support underneath Bitcoin Cash, and Bitcoin Cash is very powerful once it starts to get going, but it needed to overcome this level of structural resistance, playing through from 243.50 up to 245.90. This has been suppressing price. You don't see this kind of structure on other cryptos. We also knew that when Bitcoin Cash couldn't get above this very, very key level, this strong structural resistance level at 253.80, it was going to come down to the next one. If it couldn't hold that, it was going to go into the safety nets and then rebound. The problem was it rebounded into structural resistance. We had a lot of other cryptos that didn't have this same kind of fingerprint. They had different levels of structure. When you have a lot of overhead resistance like this, the probability is you will get price action that looks like that. But just think about it, without the indicator, how would you know? You can see that this indicator, and this is only for Bitcoin Cash, this indicator gives you X-ray vision into what the institutions are looking at, where the safety nets are, where the ceilings are, how strong they are, how weak they are. With this knowledge, you can place buy and sell decisions into the market and make returns like I make. I use these indicators for my trading. To understand how I make my trades, I look at the Tier 1, Tier 2 and Tier 3 charts, the CTKS structure. Those indicators that I showed you, they are all CTKS structure. It's vitally important to look across the Tier 1 charts and then triangulate them to the Tier 2 and Tier 3s. If you don't do that, you have no idea how the markets are moving. If you don't know how the markets are moving, the markets will unfortunately teach you a lesson through losses. Those losses are meant to be learning experiences that the market gives us, and every professional trader has had plenty of losses that they've turned into lessons. The S&P 500 has been trading since 1871. That's over 55,800 days of trading. Using recent indicative price action right now would definitely RIP our money. One thing that we can see with the CTKS method, there's a huge degree of overhead structural resistance playing out from 44.14 to 44.38. Now, what does this mean to the market? It means something very specific. The market is coming into overhead resistance. What does that mean? And this is total market structure or CTKS structure. This is very strong resistance. It means that the price appreciation inside the stock market is going to slow down, just as the CPI and PPI data hit the street. Talk about bad timing. One thing that we know, around this 44.03 level, there is structural support. It's reasonably light, but it is there. But down further around this 43.72 mark, there's much stronger structural support. Just bear in mind, what happens with structural support, it doesn't necessarily stop there and ping up. It's like a safety net. It's elastic. It can go down and then gather momentum. You have to always think in these terms. But the problem to crypto is this: as the heat comes out of the main market, the heat comes out of all markets. What is happening with the NASDAQ is that the same story. The NASDAQ has been operating, trading for over 18,500 days. When we look at the SLs and just pop on the NASDAQ indicator, what do we see here? This is really good. This is positive structural news. The NASDAQ has encountered strong structural support and actually got over it and is coming into a light area of structural resistance at 13,814. There's another level up a little bit further at 13,907, but then there's a relatively big fresh air gap up to the next structural level at 14,207. One thing to bear in mind, as the S&P 500 enters structural resistance, not so for the NASDAQ. But if you didn't have this indicator, if you don't mark up your charts with the CTKS method, you would never know. The good financial commentators out there always talk in terms of probability because financial structure is based on probability. When we look at the DXY, there's likely to be a little bit of a rally inside the market as the DXY starts to come down. But just be aware, there's a lot of structural support between 105, 53.05 and 105, 63.95. This means that even though the US dollar could come down, and that would put upward pressure on the NASDAQ, upward pressure on the S&P 500, and of course upward pressure on crypto. It could be a limited time offer because as we come into strong structural support, we expect a bounce. Look at the last time we came into this. You can see it can get really powerful how the DXY can move. But without the indicator, we wouldn't know these bands actually exist inside market structure. We just use recent indicative price. Instead of doing that, we can pop on the indicator and see where the structural support levels actually are and the structural resistance levels are as well. It's like X-ray vision. It's so undeniably powerful. Inside the service, each and every month, I create what are called CTKS Method paths. They tell us where price could go under normalized conditions based on CTKS structure, those SLs, inside market structure for the entire month. One thing that we can see with gold has been trading since 1833. That's over 69,600 days ago. Gold is currently following the negative price path. If you're inside the service, you already know where this price path ends up at the end of the month. If we look at the price paths for US oil, and that's been trading for nearly 60,000 days, we can see it's also following the negative price path. But look at this normalization across this area and look at exactly what US oil did. This is the power of CTKS structure. There's no method in the world like this one. It is the world's most powerful smart money buy and sell level detection system. It was developed by a statistician with an actuarial background who's been in financial markets for nearly 40 years. Another thing to note, there's currently an 8.8% probability of an FOMC rate increase on the 13th of December. This is a little bit less than yesterday and a lot less than what it was previously today. This means that the DXY is likely to come down into that structural support. The S&P 500 and the NASDAQ are likely to rally. We're also likely to see more positive momentum inside the crypto market. It's very important to keep your eye on the US 10-year yield, the US 2-year yield, junk bonds, gold, Bitcoin, and the DXY. You can cross-triangulate the DXY across to the euro and the Japanese yen, and this month we had a special release of the Aussie dollar, just an indicator only release just for this month. If you would like to get the structural levels, you can do so by visiting the CTKSMethod.org website. When I did my finance degree many decades ago and I started trading and investing in financial markets, I wish somebody had told me about structure. Instead, I had to find out about it myself. That literally cost me millions of dollars in losses. What I'm doing here is paying it forward, teaching you the CTKS method and helping you to understand that there's a difference between looking at recent indicative price and getting caught up in story-based analysis, or looking at what the institutions look at, which is CTKS structure. And price behavior is so simple with this particular indicator. If it's not going above, it's going below, and that's as simple as it gets. We have to just meet price reality where it is. We do three-dimensional risk management to be assured that we know what we're doing under all conditions. The market going up, the market going nowhere, and the market going down. And you can see by the previous trades, it doesn't matter what the market is doing, you can make money. And that's what it's all about. One other thing that you'll find really important, a lot of people come pre-packaged with self-doubt and self-sabotage. Unfortunately, those two things will freak you out in terms of gaining profits inside the market. One thing to always understand, the markets are not competitive. You are not in a match with another person. The markets simply pay you when you have the knowledge and the emotional control, and they take away from your profitability when you don't. This is a pretty harsh lesson, but I'm here to tell you what you need to know, not what you want to hear. A lot of people want to hear, hey, I can go to the gym and get a six-pack without doing anything. Or, hey, I can pick up a tennis racket having never played tennis and become the world's #1 tennis player. All I have to do is pop this pill. Or you can get a job and do nothing, don't even turn up to work, and you'll become CEO. That is all rubbish. And you already know it. But inside financial markets, people think it's somehow magically different from everything else in life. It is not. You must understand what you're doing. And literally, the only thing that you need to do is follow Rule 603, synchronization profits. If you synchronize in with the markets will pay you. That's as simple as it gets. There are millions and millions of traders and investors inside the market. They don't all have the same mindset that you have. If you're selling to offload, they're not buying for any other reason than they think they're getting a good deal. That's pretty much it. Unfortunately, a lot of people, when they're trapped inside Zone 1 and Zone 2, come from a scarcity and self-sabotage mindset. The key to consistent profitability is to get out of those zones as quickly as possible into Zone 3 and Zone 4. If you're interested in learning more about this, please just drop a comment and I'll cover it in more depth. It's a very important thing to learn. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.